I'm the 5-Minute Professor, and today's Financial Friday lesson is on fundamental analysis. It's the numbers which make up the actual value of a stock, and it's what you think that you use to buy and sell stock unless you actually do it. Because in theory, the idea that you would buy a stock which is going to increase their profits would be a good way to decide how to invest. In fact, it is the way that Warren Buffett decides how to invest. Warren Buffett, one of the greatest investors of our life. However, he does not do what stock market traders do. So let's talk first about what fundamental analysis is. It is taking a look at how much money a company is making and how much money it's expected to make in the future. Because honestly, stocks don't trade on how well they're doing now. They're trading on how well people think they'll trade in the future. So fundamental analysis says if you have 1 million shares of stock and your company makes $100 million, you're making $100 per share. Of course, no companies only have 1 million shares, so that's not a great picture. But the idea is that if you know how much money you're making per share, you can make a pretty good estimate as to how much money you can make in the future per share. So therefore, things like earnings should matter. Things like profitability, or the percentage of your total income that goes to profit, those things should matter basically, fundamentally. It's how fundamental analysis works. A company does better, the stock is worth more, people pay more for it. That is fundamental analysis, and it is exactly what Warren Buffett does. Now, Warren Buffett does not trade like you or I might trade. Warren Buffett buys companies, and usually he buys companies by finding a company that he thinks is a good value. Not a great value, not the best company in the world, not the next Apple, not the next home run company, but companies that he thinks are doing well but need money now. Because they need money and he's got money. So he loans them money. But he does it with a vehicle that allows the bond, or the money that he's letting them borrow, convert into stock. They're convertible bonds. So the whole idea is he's going to loan them millions of dollars with the anticipation that when the stock performs well because of this loan, he can convert that money from money into shares of stock. But because he loaned the money, the people who purchased the money don't have the decision as to whether or not it gets converted. So that if the stock does not perform, they still owe him the money. So if you could buy stock from your broker, and if the stock goes up, you make the money, and if the stock goes down, you still get your money back, well, of course you'd do that. Well, that's what Warren Buffett does. So when people say, I want to invest like Warren Buffett, get yourself a couple of $100 million first, then you can start to invest like Warren Buffett and trade in companies that you think are undervalued. Stocks that should trade better than they are, but aren't. And then you loan the money, and then you get it converted into shares of stock. Until that day, don't trade like Warren Buffett. Now, to be fair, Warren Buffett thinks the stocks are going higher, so if you bought the same stocks that Warren Buffett was buying, you'd probably be okay, except for, well, his announcements trail by about 90 days. Sorry. Perceptum, quispium, damnatium. Learn something, damn it. I'm the 5-Minute Professor, and thank you very much for listening to today's lesson. If you have any comments at all, please put them in the comments section down below. And of course, like it and subscribe to the channel. But most important, if you liked it, if you commented, and if you subscribed, tell your friends. Perceptum, quispium, damnatium. Learn something, damn it.